Hello, and thank you for joining us today in this large cap podcast. I'm Eugene Chang. I'm the head of institution at Bybit. Joining me today are our co-founder, CEO Ben Zhou, and our good friends from our custodian partner Copper, Michael Roberts, global head of sales, and Simon Morgan, head of exchanges at the Coppers. So today we are going to talk about my favorite topic, asset safety. When I first joined Bybit 2 years ago, and most clients I talked to, the first discussion is all about fee schedule, max API limit, how much we can give it to them. And surprisingly, only a handful were inquiry about the third-party custodian in our initial discussions. But nowadays, we see a increasing in the institution client inquiry about the third-party custodian support. For many of these firms, it's no longer a luxury, but become a necessities. So that's why we have been collaborating intensively with the team at Copper, and the Bybit has officially integrated the Copper custodian service on the June 12th. So kick the things off, I'm going to ask Mike and Simon to tell us a bit like what is driving this growing emphasis on the asset safeties and then crypto custodians, and what are your institution clients prioritizing today?
Yeah, good to be here, Eugene. And yeah, look, it's very topical. I mean, I think back to, just after FTX happened and, you flew to London, I think maybe a week or two after that to see clients discuss, custody with us and how we could, improve the system in terms of client asset protection. So, what's driving that is, there's no new mistakes in markets. And it really goes back to the days of things like Madoff and even before then. So institutional investors, they cannot use self-custody, which is a fantastic innovation that, cryptocurrencies have brought to the market. Firms like yourself have democratized investing for retail customers and the growth is exceptional. But for the institutions to kind of grow and play in this market, particularly for pension funds and asset allocators to allocate to hedge funds, they need that separation where they can have, the assets sitting at a custodian or a prime broker. And then those assets, more than that, even the custodian and prime broker is double checked, particularly after Madoff, in that there's administrators that check those assets as well. So, we think this technology is going to change the world, but there are situations where if we want the institutions to come, you have to respect some separations there, which I think, both our firms are doing. So that's what's really driving that adoption. If you split the two client bases and think about how they operate, it's just different setups for retail versus institution. Anything else there, Simon?
All I would add is, as you well know, FTX was a seismic moment for this industry, and actually, even though it's caused an enormous amount of pain, I do think the greater good for the institutional world, a lot of good stuff and innovation has happened as a result. Clearloop itself was actually around way before FTX. It was around in 2020. It was first launched, so we had some, great experience pre-FTX of driving this narrative of protecting assets in a third-party custodian, et cetera. But that really brought it front and center to everybody that this is, frankly, the most important issue for any institutional investor who wants to get involved in the crypto space. And it's incumbent on all of us who work in this industry to really provide the rails and the infrastructure which make institutions comfortable to trade in this world. Frankly, while crypto gets an enormous amount of airtime, and we're very grateful for that, all of us who work in this industry, it is still tiny. It's nascent. I mean, there are 6 or 7 companies that trade on the S&P 500 that are bigger than the entire market infrastructure, the entire market cap of crypto. So we need to keep that in mind, that there's an enormous amount of growth still to come. But we need to have, systems like Clearloop in place to allow institutional investors to feel that comfort when they're trading in this world.
Yeah. So thank you, Mike and Simon. I think these are really good summaries. As an exchange, especially we do see a growing demand with custody service, especially from institutions and really big clients, right? And we have been asked, and we do see a lot of custody approach Bybit. And I think we actually incorporated and integrated with Copper. To be very frank, it was because the growing demand and a lot of institutions are asking. So I think for the benefit of the audience, what makes Copper different? And obviously after FTX, a lot of these type of custodian service existed. What makes you stand out? And can you explain why the growing demand from your side? Yeah.
Yeah, no, thanks, Ben. It's a very good question. So I think, Copper is really a tech first firm. So the founder, Dimitri, he really is a product and technologist at heart, but he comes from a background of traditional markets. So, when he was looking at the solutions out there for custody, I mean, obviously we all understand ledgers and, owning your private keys and all these types of things. But as I mentioned right at the start, of our discussion, institutional players can't function like that. So he started to design the technology to, enable institutional players. And then more than that, when you think about how trading has changed and the level of access that an exchange like Bybit gives their customers, direct trading, UTA accounts, etc., speed was at the forefront of his thinking. So we are very, very true to, deep cold storage and having all the key shards offline and all that good stuff. But we also have our technology architected in a way where we can do cold, warm, and hot wallets. And that, is a distribution of key shards in different levels of safety. And, the hot wallets allow, rapid settlements between the exchanges and custodians. So, that piece of technology, when we architected it, allows, the high frequency firms, market participants to handle this asset in a way they want to. So I think that's really what's put us in a strong position in that, we have a very, very rapid deployment that allows these assets to move quickly and then get back down into cold storage. So it's probably that design that held us in good stead. But quite frankly, we do want to see, other participants join the space, other custodians, etc., because, we're grown-ups, as our Bybit, and we're well aware, big hedge funds, etc., need multiple providers. They're not going to have concentration risk with one firm. So we're also pragmatic about that and looking for solutions in that space to kind of push things forward as well.
Awesome. Yeah, Eugene, you want to continue? Yeah.
Yeah. I mean, to follow on that, right? And because your office right now is in London,
Yep.
right? So how might the whole like EU market in the crypto asset regulation gonna impact your operations, versus your other competitor, especially in the coming years?
Yeah, no, very good question. So, I mean, I guess, again, all things with this market, because it's a new innovation, we have to kind of split, what we would call crypto native custodians, and we include ourselves in that, and then the traditional players. The traditional folks are struggling to turn up at the moment in the absence of regulatory framework that makes sense for them. But that is coming thick and fast, particularly in Europe. The MiCA standards are actually quite impressive, and I think it's going to allow some of the traditional folks to step in. The UK is now, bringing forward a framework that we hope is going to be similar or better than MiCA. And then, that is something that we have to react to. Currently we are set up in Switzerland because they have the best regime for all the different services that Copper can provide. But then now we have a greater breadth of, regulatory options, and we are pursuing all of them. But what Simon and I are very kind of focused on and interested in is, the traditional space. As the traditional folks come to this space, we can either partner with them, we can lend out, we can actually lend out software to them, and they can use that side of it, etc. So we are trying to be nimble in that we will be a custodian in the crypto native space and trigger all those regulatory standards as they come to fruition, but we're also, again, pragmatic that we might need to partner or let our technology be used by bigger firms as the market demand kicks in.
Yeah, I would just add that. I mean, Mike has referred. Oh, sorry, Eugene. I was just going to say, I would just add that Mike has referred to a few things there, which in terms of partnerships and stuff, which we may be announcing hopefully pretty soon, where it gives our clients optionality that they don't have to face Copper directly, but can access other partners of ours to in different regulatory jurisdictions which satisfy their needs. So we're very pragmatic, as Mike said about that. We just want to grow this ecosystem and get investors involved in crypto, basically.
Yeah, because I want to add that, like, I know, like, both Mike and Simon, you both spend a lot of time in the traditional finance. I think Mike's been like 16 years with Bank of America.
Yeah.
Yeah. So I think that two of you have a lot of good experience and then right expertise to help just kind of transitioning from the traditional financial to the crypto?
Yeah, no, I mean,
Yeah,
look,
sorry, Mike.
no, you go, Simon, please.
I was just going to say, look, I did 22 years in equity sales trading, running sales trading at Virtue in Europe and KCG and Knight, and actually through that period saw an awful lot of change in the equity market, from the dot-com bubble bursting to the financial crisis to the electronification of markets, and a lot of upheaval and good times in those 20 odd years. And from that gives you great experience to understand and deal with events like FTX and all the blowups we had in 21, 22 in this space. And, you can take a step back and assess that actually the world does keep moving forward and things do continue on, and you can just be a bit more rational about these sort of things, but also learn the lessons that have gone before, and therefore build products that clients need, and particularly institutional clients, to make sure that the space is stronger and more resilient going forward.
Yeah. And I mean, look, I'd add a little bit to that, because my history was exclusively prime brokerage, and there's a lot of kind of, I guess, bad press in the space about what's gone on in crypto. But I'd like to kind of remind everyone that, in 2008 in Europe, in the prime brokerage space, there was a thing called unlimited rehypothecation, and all the prime brokers used to, on an unlimited basis, rehypothecate client assets. It was in the client agreement, and the clients knew that it was there. But in reality, as the market was growing, they hadn't really thought through what it meant. And that it created a lot of liquidity issues that happened with Lehman's and my old firm, etc. And then after that, two things happened. The regulations changed, which put limits on rehypothecation, and clients were extremely focused on client asset protection for, I would say, 2 or 3 years, probably more, maybe even 5 years. So their lawyers were telling them to look at this. They were checking the client asset statements that we had to produce as part of the regulation, etc. So, there's a perception that this is a crypto phenomenon, but this has happened before. Everyone learns, moves on, and builds a stronger system. So I've kind of seen this before in a different setup, and the market will get through it. And firms like Bybit that react quickly and care about protecting client assets is exactly where we need to be.
Yeah. Okay. Yeah. So Ben, actually, we seeing a lot more institutional client today onboarding with us, integrate with us, right after the FTX collapse. So what exactly, Bybit we have been doing to navigate this crisis period, and then how we able to restore the market confidence and actually getting more client even than before the FTX collapse?
Yeah, good question. I think I want to answer your first question is that the previous part, that what did we do during the whole crisis, right? So as exchange, I think when something like FTX happens, the first priority during that a few days, what we did was focus on expediting all the withdrawals. When people are panicking, you don't want to give them anything other, just let them withdraw and give them the most efficient withdrawal. And actually, I think Bybit was one of the most efficient in terms of withdrawal. We lifted a lot of usual risk management measures to allow people to take their money into their wallets, whatever, so they have a safe, they feel safe basically. And eventually, we see all these clients coming back. So this was the first decision we did. Number two, as exchange, I think now everyone offers proof of reserves and all that. So increasing more transparencies. I think, to be honest, compared to traditional industry, the crypto exchanges now are actually a lot more transparent, in the sense that actually we really don't use clients' fund to do anything else. And it's in the wallet, where I think in a typical bank probably can't even hold a 10% bank run or something, right? So, but lastly, it is to work with companies like Copper to offer a non-custody or non-centralized exchange custody solutions where they feel safe. So I think this is also one of my questions, maybe for Mike and Simon. I want to understand, for the sake of this podcast, is how many exchanges have you integrated? Any issues, any things you see that's positive from the exchange, any things you look forward from the exchange side for us to improve on? And obviously, lastly, I think my question would be, Copper is still a very institutional focused product, where there are a lot of retails in the industry. What do you think of the direction of the industry? Are we moving towards a solution that can even offer to some clients who have only $100? What is there any plan in your pipeline? So I think these are something really interesting for me.
Mike, shall I start and you finish me off?
Yeah.
So, I mean, then you bring a lot of good points there. And, again, I hate keep harking back to the same thing, but FTX was a seismic moment, as we already said. And that sort of is the inflection point for huge growth in Clearloop as a product set in terms of engaging exchanges and integrating exchanges and so on. So at the time of FTX going down, there were 3 exchanges live on Clearloop. That number is now 8 as of today, and we will have a further 4 integrating over the course of the remainder of this year. So we should be up to around 12 exchanges by the end of 2023, which is a huge achievement, and that is way bigger than any of our competitors' products which are coming to market. And as Mike said before, we hope they do expand on those. But so Clearloop by far and away is the largest, and to our mind is the most thorough in terms of what we require our partners to do, i.e. post collateral to our legal trust and so on and so forth, and our risk metrics that we've all been through many a time. And we have our risk team monitoring that 24/7 and so on and so forth. So Clearloop has had a lot of thought go into it. It's been a lot of hard work. Every exchange, as you probably well know, they're all different. They all have their various idiosyncrasies, and we've had to deal through all of that. And frankly, we all get on very well, but there's language barrier to get through. It's very difficult, and so it's taken a long time practically to integrate all these exchanges. But we're pleased to say that we're now in quite a strong position in terms of being able to offer our clients those different liquidity streams from these various different venues, and see there, there's lots of further growth still to come. There are a couple of exchanges who we all know who are not part of Clearloop yet, which we hope will join at some point, because I think that strengthens the whole industry and gives people even more comfort than they currently do have. And that's what will ultimately facilitate more growth from more clients and everything else. When I joined Copper in early 2022, at that time, all the big multi-strat hedge funds globally were lining up to really get involved in this space. Now, that has obviously all been paused and put on hold. I do think that time will come again, hopefully early next year and so on, as things recover. And the narrative is starting to change within the crypto world. We've had these 2 positive law cases recently with Ripple, and then obviously the Grayscale case very recently. It seems, I don't like to say inevitable, but we're all very hopeful that this ETF is going to get passed in the US. And I think that's just going to fuel further price appreciation, really. And I think that the one thing that we don't acknowledge very often as an industry is ultimately the price of Bitcoin really matters. FOMO of missing out of price appreciation from institutional investors is really what gets them excited and interested. So we need a bit of that. That should foster growth. And at Copper, we can probably talk about this later, but we have other projects ongoing which we think will really foster that growth and encourage clients to really get involved in this space, some of which we're working through with you guys at Bybit on the product side. So I'll leave it there and let Mike add, but we're very enthused about the growth of this industry.
Yeah, I think that's a good summary, Simon. I mean, Ben raised a couple of interesting topics which we should press on, right? I mean, look, the promise of blockchain technology, cryptocurrency, etc., is to improve, the financial system, democratize it for retail, make it more, of the moment for traditional finance, which, does use technology, but has deployed it from many, many years ago, and it's incumbent and very hard to change. And what I would say is, and then I've got to call out, Bybit and our exchange partners on this, is the structure we now have, if it's looked upon in great detail, and I think both firms would invite this, is, the risk methodology we all agree together, the UK trust structure that was, designed by Linklaters, and obviously we've all signed up to, is innovative. These are bearer instruments, and we have to think about, the protection of interest for everyone, our clients, the exchanges, the exchanges warehouse risk as well. So, the structure of having it inside a bankruptcy remote trust, because look, Copper is not bony. We've been smart enough to realize that clients are not going to look at us and say, okay, you're the size of Boney, we can take counterparty risk to you. This is an insolvency remote trust which protects the exchanges, our clients, and it's insolvency remote to copper. That's a new innovation that we all came up with. And then second to that, what it's allowed the market to do is clear risk in the system every 4 hours. So Bybit, unlike exchanges in the traditional space that settle collateral once a day, and Eugene was in this world, and I think that's why we moved this on quickly, because he understands this stuff. We are now settling risk for our clients and for you versus our clients every 4 hours. So that's continues to go on, and I think we all know, due to how this technology is deployed, we could move that to an hour if we wished. We could move it to 15 minutes, but 4 hours is sensible. That's a massive, massive innovation. So we are moving this forward. We've gone through a tough time. We're moving things forward. To your final point about how do we democratize this for retail, we actually have something interesting coming along. I mean, look, we have to respect the fact that it's in the design stage at the moment, but the technology allows this to happen for institutions. Of course, it can allow it to happen for retail. It's just how we design it, a little bit different to institutions, as I mentioned at the top of our discussion. So we're hopeful that will work. And then it gives, our retail, clients the ability to potentially, benefit from this structure as well. Copper has to think carefully how they do that, because we face institutions only. But, watch this space. We think something interesting is coming.
Yeah, thanks for mentioning that. Yeah, I remember in the CME, the settlement at least like T+1, right? At least it take like an extra day before everything can settle. And then like in the crypto space, I mean, 4 hours, that makes a lot of difference.
Massively.
Yeah. That's actually kind of in line. Yeah, go ahead.
It's just proving the point of blockchain, isn't it? I mean, that's what we all aspire. That's what we all talk about. That's the whole point of this industry, and it's demonstrating to the traditional financial world that you can do this stuff efficiently and quickly, and ultimately cheaper than you do at a bank in the traditional world. I mean, what Mike refers to, and that we're settling down all these trades, we're doing that with a team of 6 people in the middle office. I mean, it's wildly efficient versus what happens at a bank, and that's what's exciting.
Yeah,
I think why I think this is why we're all here, is that this industry really will change how things are run, right? I want to share a bit. After the whole FTX thing, one of the key initiatives Bybit did was trying to really fill in the gap with our unified margin system. For those of you who don't know, the UTA is a trading margin system that allows you to trade spot, futures, perpetual contract, and options all using the same margin. So it's extremely efficient for people, especially institutions, to trade, as is the best margin efficiency system. The reason I brought this up is that I'm kind of curious, is Copper see yourself as a pure safeguard or a custody service that provides safety as a priority? Because I would assume for any institutions that's already using your service, they probably are asking, are you going to offer any sort of portfolio margin system or any ways, because you are connected to multiple exchanges, for them to be even more efficient? Because from Bybit perspective, I can make all my product connected to be, that's the maximum level I can do. Where you could do is to connect all the exchanges, and then that's a whole layer of new things, the new world to explore. I don't know what's your plan. Maybe you can share a bit.
No, I'm happy to talk about that a little bit. It's firstly the UTA account. I agree with you. I mean, clients love it. The feedback we hear from particularly the high frequency trading firms and the sophisticated traders is they love it. There's not a lot of products out there, particularly the fact that you've made it low latency. That's impressive, and it's where the market needs to be. So it's a great product, and how would we kind of harness that on a wider basis? So I come from an old world of prime brokerage where the bank was putting up its balance sheet to do that kind of margin optimization across products. Now, in the digital asset world, everything needs a little bit of a rethink, because number one, the technology is different, and you've got to lead with the technology first, rather than try and bring in old models and shoehorn them into the technology that's there. So think about the technology first. And then secondly, think about the fact that there are, no real large balance sheets in crypto, like, my old Wall Street bank. So what we've tried to do is, and we're very purposeful about this, is, we're a custodian that provides prime services, not prime brokerage. So not the lending. We're providing the rails for clients to, number one, interact with the exchanges in a safe and efficient manner first. But the trust structure, Ben, also allows safe lending, right? So what you can do in that trust structure is that, the exchanges and the clients are interacting in a safe way. The next thing this market needs is the liquidity conundrum to be solved, right? We need better liquidity, and we need, the provision of leverage in a safe way. So I think the ETFs potentially getting approved gives us a different type of liquidity in the market. Fantastic. What we now need to see is, lending come back in a safe way. And, we're speaking to multiple lenders around bringing their lending books to copper. So let me be clear on that one. Copper's not lending. It will be other lenders that want to bring their lending books to copper. And then they can, through the legal construct, lend into the trust, knowing that their bearer assets are inside that trust. And they get all the protections that are afforded to them, as our clients and the exchanges are. So that starts bringing everything together. Now, across that, could we provide some collateral management optimization for the lenders, clients, exchanges? Absolutely. But think about it as we're providing the rails to bring that marketplace together and providing that information to, prime brokers, etc. We see ourselves as that, the safety play, the rails for this ecosystem. So I think you're right, Ben. We're definitely moving to that space. But I think, as with everything in crypto, there tends to be three counterparties in everything. The client, a custodian, exchange. This is probably going to look something like a client, the custodian, and a lender, right? We bring that conundrum together. We give them the data. They can optimize margin, etc. Plus your UTA account. I actually think that blend is quite potent. And it, again, when you put it all together, is far more optimized than the traditional space. So hopefully that covers the thinking, and if there's anything you want to ask on that, happy to kind of chat it through.
So the lender in the traditional financial world usually is the prime broker.
Correct.
Right. So one thing I just want to add a comment is there are some prime broker business kind of happening in the crypto space. But I mean, in my opinion, in order to really have a very sustainable prime broker business, I think one of the key criteria is I really need to have a very good custodian provider, or custodian kind of like a model to support that business.
Yep. Look, we hear you, Eugene. This is where we're trying to build these rails so that the lenders in this space can operate and grow their businesses. There's a very clear distinction we need to make around prime brokerage. And both models have different benefits to them. But in the traditional space, there's collateralized prime brokerage lending, which is, my old world, equity prime brokerage. And, if a client borrows money off the bank, they then put up their collateral through rehypothecation so that money can be replaced in the repo market. Right, so an efficient prime broker doesn't use their balance sheet. They use the client's assets via repo to replace the lending. And that collateralized lending makes the whole ecosystem quite safe, because as the book unwinds, if a client needs to unwind their book, you return the repo, it brings the market down in an orderly fashion. Now, crypto as it currently stands is the collateral in the ecosystem is too important. It needs to be used for trading purposes until we can bridge the gap between crypto and traditional assets, which we're all working on. So the model that is currently in place is kind of like an FX PB model, or a derivatives intermediation model. And what you're doing in that space is, many times not collateralizing the loan, and you're taking credit risk. Now, prior to FTX and all the things that happened with Celsius and BlockFi, etc., we saw what happened with that credit risk, because they're bearer instruments. They go around the market. It doesn't get returned. You create liquidity issues, etc. What we're trying to do here is create a situation where these assets can be lent potentially on a low collateralization or uncollateralized basis, because they're in the trust, right? We actually have technology that allows the lenders to lock the asset in their account and then lend it through to a market maker through what we call delegation, and then that can go up to the exchange. So look, us partnering and doing what we're doing allows the first leg of the next innovation of this market. So look, you need old knowledge like we all have blended with the new technology to bring this market to where it needs to be. So it's evolving. Prime brokerage in the traditional space took 25 years to build. This market's building prime brokerage in 5 years. So, that's just crypto.
Yeah. And bluntly, just to add to that, we're here to empower the prime brokers that exist. We're here to empower them and actually reduce the risk that they're taking versus exchanges in terms of a counterparty risk. So, we've made some announcements with our various partners in the prime space, and there's sometimes a misconception that we're here to sort of compete. We're not. We're here to use Clearloop to enable them to actually scale their businesses in a much safer, larger way, because ultimately we all understand that the need for primes in this world to actually allow institutional investors to really get involved. So yeah, I mean that's our simple message. We're here to help, not to compete.
Okay. So, I mean, on other things I'm interested in is like, so we all know now is a bear market, right? So what are your current priorities in the bear market?
Yeah, look, it's going to sound very cliche, but we've just got our heads down building, right? And that's what you need to do in these markets. Working with really good partners that want to move the ecosystem along. Educating the market like we're doing now, because the market changes at a pace, and then just head down build. I mean, we all know the work that both teams put in to get this live. We can timestamp it, right? November last year, you were over here, Eugene. Shortly after that, our team started meeting, working on the integration, the legal docs, etc. So these integrations are technology integrations, but they're also legal integrations and risk integrations. So we got it done quickly. Both firms got it done quickly, and we thank you for your partnership. But repeating that, as Simon says, 12 times this year, it's a heavy lift. But we're doing it for the good of the ecosystem, for our clients, and for everything to grow. So hopefully when the next cycle comes, and I think we all feel it's probably around the corner, hopefully some good announcements to the ETFs, etc. When that flood of market participants come back, they have the options they need to grow, whether it's with exchanges and everything you're doing in the UTA space, copper with Clearloop, prime brokers lending in a safer way, heads down building. Next cycle, hopefully we grow in a sustainable way, and more come to the market, because I don't think anyone around this table wanted to go through the kind of scandals that went through last year. It's just not what we're about, right? We're here to grow the system that way. So that's what we're doing. We've got other products, Copper Pledge, to help with the derivatives OTC market, and that is once again Copper's principles. We're there to protect assets and try and reduce risk in the system. We've been asked to build technology around settlements. So there was one-way risk in the system where the smaller guy used to tend to have to deliver to the bigger guy at the OTC desks. We've now built PVP settlements where it links the two assets together and reduces the one-way risk in the system. So just head down building that, Eugene. So when people need these bits of technology to grow their businesses, we're relevant and we can help them grow. Anything I've missed, Simon?
No, I mean, look, all I would add to that is despite it being a horrendous bear market, and we're all a bit sick and tired of it at this point, but, things are seemingly starting to improve a little bit. But, Clearloop, it has grown significantly, and I think Bybit has in this period too. So in some ways, if we can grow our businesses in this, depressed sort of market state, then that's extremely encouraging. I mean, just to put that in some sort of perspective, I mean, not only have our exchanges gone from 3 to 12 by the end of this year, but our assets sort of delegated via Clearloop have gone up, has increased by over 40% since January. And actually this month in August, and August is normally a very, very quiet time, and it has been again this year. We will see over $12 billion of notional value go through the Clearloop construct, which in itself isn't a massive number, but it's becoming meaningful. And I think, if that continues to scale as the market grows and all the participants who sort of stepped away a little bit come back in Q4 and beyond, then I think both us and you guys at Bybit are in a good spot. So we are encouraged about, what is around the corner.
Okay. Well, my last question.
So,
go ahead,
sorry,
Mike.
No, something I must mention, it just kind of came to mind, is we hear clients, and again, we go back to our exchange partners that have connected to this ecosystem. Is the connection allows them to carry on doing their trading in situations where maybe cyber incidents have happened, or there's market rumors that have taken place, etc. With clients that don't have a connectivity like we have put together, Clearloop and Bybit. If they hear a piece of market news, or they there's a cyber incident or something that they're concerned about, what they have to do is switch off their trading, pull their assets and stop making money, and then create situations where exchanges have to manage their treasuries at short notice. What we've seen in this market, and I don't include Bybit in this because there's been no news in this space, but there's been other news from some of our exchanges, whether it's real or otherwise, that has hit the market, and our clients don't move their assets, right? They keep trading. They know their assets are sitting at copper. And what that allows the market to do is, number one, clients, their performance is where they expect it to be for the day because they have targets to hit. So if they were expected to make X amount of P&L today and have to switch their algos off and pull collateral, that's not good for a hedge fund, right? They're not going to be able to keep raising money and put up performance numbers. But secondly, and we think this is an important thing for the ecosystem, it allows, if there is a bit of news out there or a cyber incident, it allows the exchanges to react to it and not be managing assets being pulled off the exchange when they might need to be looking at something else. Now, we've seen that with a couple of exchanges, and it's been good for the clients, and it's allowed the exchanges to actually breathe and sort out what they need to do. So I think that's an important point as well, right? Is that this does make a great deal of sense for institutional investors that have to move quickly if they see something they're not comfortable with. It kind of stops that, it puts a speed bump in place.
Thank you. My last question is, so when do you expect a bull market going to come?
I'll let Simon answer that one. No, we'll both answer it, but you go, Simon.
Oh, do you looking at some kind of like a significant trigger, for that will happening? I mean, Ben can answer the question too, right?
I mean, look, all I would say is globally, clearly, the whole world is under pressure in various ways with rates the way they are and everything else. And, I think all of us will sit back and say, I'll just buy a treasury and take my 5% yield and thanks very much, and wait till things get a little bit clearer and maybe a bit better in terms of inflation and stuff. But I mean, all that at the same time, the narrative, as I said earlier, in crypto is changing. I think it is definitely changing. All the issues in the US are seemingly coming to a head. And I think the fact that now, if somebody had said to you 12 months ago, you would have 7 of the world's largest asset managers all applying for spot Bitcoin ETFs at the same time, and they now seem, I think Bloomberg put a 75% chance they're going to get approved, in the next few weeks, then that is hugely encouraging. And that should encourage everybody in this space. And it is a cliche, as Mike said before, but I think the systems are now in place and the partnerships are being built between custodians and exchanges and so on and so forth to allow these guys to play in this world. At the same time, I also, Copper is involved in other projects to do with blockchain infrastructure and sort of changing financial markets. And we will have an upcoming tokenization project, which we'll be talking about very soon. And I think that in itself can empower institutions in a different way to hold traditional assets, borrow against them, and ultimately deploy them back into the digital asset ecosystem, or not, either way. But it's using blockchain for what it's always promised, and that is to make financial markets safer and more simple, quite frankly. So that alongside, and the other thing I would say, Eugene, which we've been working very closely with your team at Bybit and your product team in particular, is things like talking about structured trades. It's an age-old thing in traditional world, but you think about staking and what you can do with staked assets and how they can, again, be used via your UTA account. And there are lots of things where you can start to get real size into this market with yield enhancing sort of trades. Now, in a world of 5% interest rates, that's not as needed, but if we can get those rails in place for when the world sort of renormalize, well, I say normalize, it has normalized, when it goes back to a lower interest rate environment, then I think that in itself will be an exciting opportunity too. So there's lots of stuff to be keen on and get involved with.
Yeah, I mean, as a different view, because I agree with that, but it was a different view. Maybe regulatory change surprise us to the upside. I think there's a kind of big push now for regulators to react. Certainly very impressed with what's going on in Hong Kong. That's moving at a pace, and that kind of came from nowhere. So that's happening. The UAE, ADGM, they're very forward thinking. So what typically happens, and this is why we all like markets where it's a free market environment, is regulators reacting to the opportunity for their regions compels other regulators to react for opportunities for their regions. And then, we'll hopefully get to a space where this makes sense for the big institutions to come and play. I mean, coming from a prime brokerage background, the lending activities need to be there. They're the oxygen for hedge funds to grow, to extend their returns. They raise capital and then they leverage that capital in a kind of responsible manner. That's what gives the outsized returns to their investors. That's what grows the market. So, it's why we go back to let's build the rails so that the prime brokers in the space, lenders in the space can kind of fill that gap at the moment in a responsible way. Let's let the regulations kick in as they will over time. And let's show, the traditional players what this could look like, what good looks like in the digital asset space, so that they can take what they know from the traditional space and plug it in, and then the two worlds come together. What is desperately needed here is a mix of collateral. We need to take, digital assets, crypto, and digitize, treasuries, equities, bonds, etc. Because the prime brokerage model, the proper prime brokerage model, is to take these assets and use them as collateral to collateralize loans across multiple assets, as Ben quite rightly said. So, I think we're all building that. I think the regs are coming into play for that. And let's hope the next bull cycle allows that to really entrench and dig in, because I think, everything's a cycle and we need that to really bite down and be part of the ecosystem. So, there's a bigger market the next time the market does trend down.
Thank you. So before we wrap this up, Ben, is there anything last thing you want to add? You're on mute. Ben, you're on mute.
Oh, I am on mute. Sorry. Yeah. So to say, I guess, we're currently definitely in a kind of a bear market. I think we operate in a quarterly base with all the KPIs and all that. And I think this quarter is literally one of the worst quarters in terms of volatility. So we will definitely see things are picking up, and then I think there's some good news coming out. So I think as exchange in the bear market is the same. We're building the foundations. We're trying to make sure the product is good so we can take the best advantage when the whole bull market comes back. So yeah, I think this is my comment on that question. Okay.
Okay. Thank you for everybody. Thanks, Mike, Simon, also Ben, for your time.
Eugene, before we go, can I just give a big shout out to my dear friend Bella? Can I just say, throughout this process, dealing with you guys at Bybit it's been great. We've had good, interesting conversations throughout, but we've always found a way forward, and that's been really important and made the integration so seamless, to be honest. And I know Bella has been a huge part of that, particularly dealing with us in London. She is amazing with clients. She's been nothing but helpful throughout. So I just wanted to make sure that you are fully aware of that, and we're very grateful.
Yeah, fully aware. Because it's not easy, right? Because like when we do integration, don't forget we're actually also changing a lot of things, right? We're moving a kind of UTA right now, right? So it's making it more complicated, right? So one thing we're doing right now is like able to support a UTA loan, right? We finished the foundation. Now we're building on top of these, foundations. So it's still a lot of work. Yeah, we'll definitely share your appreciation with Bella. Thanks, that.
The second actually carries your brand extremely well. The street knows you as a friendly and client-friendly exchange. It's exactly where you want to be. She's a credit to the firm.
Yeah. Awesome. Thank you.
All right, gentlemen. Lovely to see you again, and thank you for your time.
Thank you. Thank you.
Thank you. Thank you, everybody.
Cheers, guys.
Bye-bye.
Bye.